The entry is placed on the close of the rejection candle that forms after the third touch. You're anticipating the market to continue down from within the pattern, without waiting for a breakout. Now down here, we have what's called a reduced risk entry. This is where the entry order is placed after the structure has broken. You're basically waiting for confirmation, letting the market show its hand first. Pretty simple and straightforward, right? So let's line them up. First, we've got our risk entry, and second, we've got our reduced risk entry. Both are valid. It just depends on the position, the sequence, and your confidence in the setup. All right, so everything we've learned so far has led us to this very moment. We've covered how to take a risk entry, and we've also looked at how to reduce that risk using the PSE model. Now it's time to take things a step further. In this section, we're going to dive into how you can reduce margin for error and make sure your entries are as close to perfect as possible. All right, on the screen right now, we've got two powerful candle entry examples that can seriously help reduce your risk when entering a trade. The first example is what we call the retracement entry. The second example is the high test entry, also known as a rejection wick or a fake-out candle. Depends on what you prefer to call it, but the concept stays the same. Now let's paint the picture. Let's say all of your conditions are perfectly lined up. Number 1. You've identified the 1, 2, 3 market structure. Number 2. You're sitting at the third touch or a key zone. Number 3. Your sequencing is clean. You've already done the work. Now you're just waiting to execute. You decide you're going to take the risk entry at the area marked with the circle. Now here's the important part. What exactly are you looking for at that entry point? You're looking for rejection. Not just a candle being there, not just a line being touched, rejection that confirms the area is being respected. This is where a lot of traders go wrong. They see price at the zone and hit sell or buy without thinking. But here's the truth. Just because price touches a level doesn't mean it's ready to reverse. You need to see the reaction. So how do you spot that reaction? Let's break down the retracement entry. Let's say price is pushing up into your area of interest, but then momentum starts to slow. You get a candle that retraces 50% or more of the previous bullish candle and closes bearish. That candle, right there, is your trigger. It's telling you, hey, the buyers are losing steam and sellers are stepping in. You'd place your entry below that candle, with your stop loss just above it. Simple. Clean. No overcomplication. But here's the real world. The market is not always textbook. You're not always going to get one beautiful wick and an obvious bearish close. Sometimes you'll get 2, 3, even 4 wicks faking out before the actual move happens. And that's okay. The main concept still applies. You're not looking for perfection. You're looking for rejection. The second entry example, the high test candle, is another form of rejection. This one usually looks like a long wick to the upside, with price closing near the open or low, showing strong seller pressure. This entry is great because it gives you a clear invalidation level. You can put your stop just above the wick. But again, don't be robotic about it. If there's heavy bullish momentum coming into your zone, even if you see a wick, pause. Use your context, use your logic. Is this a true rejection, or just a temporary pause before another push? This is where experience, screen time, and backtesting make all the difference. And here's something I want to emphasize, because a lot of traders forget this. Your goal is not to have the tightest stop loss. Your goal is to have the right mindset, the mindset of a consistent winning trader. That means following your process, waiting for your confirmation, managing risk properly. Because at the end of the day, it's not about catching every trade. It's about catching the right ones over and over again. Don't chase perfection. Chase consistency. Keep showing up, keep refining, and the rest will take care of itself. All right, so now let's get into some chart work and apply everything we've been talking about. Right here, we're looking at US dollar to Canadian dollar on the daily time frame. You'll notice we've got our 1, 2, 3 touches playing out beautifully. And if we observe the price action closely, you can see that we're positioned really well. Price has just reached our area of value. Now, on this third touch, this is where we start to look for buying opportunities. We're not just jumping in randomly. This is a high probability zone. So now we start focusing on confirmation. What are we looking for? We want to see rejection candles, something that shows price is respecting the zone and buyers are stepping in. Take a look at this first bullish candle. It's showing some momentum, but it didn't quite retrace 50% of the previous bearish candle. It's a decent candle, but not quite enough for us to commit just yet. Now look at this next candle, perfect rejection. Not only does it show strong bullish intent, but it also retraces more than 50% of the previous bearish candle. That's exactly what we want to see. At the close of this candle, this becomes our ideal risk entry point. So we're going to place our buy entry right there, with our stop loss below the rejection candle and our take profit set at this previous high over here. Clean and simple. Now let's be real for a second. The market is not always going to be this textbook. You won't always get a perfect setup like this. But when you do, and your structure aligns with clear rejection, that's where you take action. The market might not be simple, but we can be smart. Smart with our entries. Smart with our confirmation. And most importantly, smart with our risk. That's how you build consistency. Let's take a look at another example, because as you know by now, the market is situational, and every entry is different. All right, so this one right here, it's not a perfect example, but it'll do the job. It's actually good to see setups that aren't textbook, because that's what most of us face in real trading anyway. As always, we start with our structure. 1, 2, 3 touches, clean and clear. Now, on the left-hand side, we've got our area of value, and once price comes into that zone on the third touch, that's our signal to start watching for buying opportunities. And right here on the third touch, look at these rejection candles. They're not massive, but they're solid, showing that buyers are starting to step in. You can see the wicks rejecting the downside and price struggling to push lower. Now pay close attention to this strong bullish candle right after the rejections. This one's important. It's showing clear momentum in the direction we want. So when this candle closes, that gives us the green light. This is exactly where we can place our buy position, with our stop loss tucked just below the rejection area. For our take profit, we're aiming for the previous high. That gives us a logical, clean, and achievable target. And as you can see, boom, price moves in our favor, and we're hitting profit almost every time with this kind of disciplined, structure-based approach. Again, it's not about perfection. It's about making smart, informed decisions based on structure, confirmation, and momentum. That's how you stay consistent. That's how you win more often. And that's it for today's lesson, traders. We've now taken everything we've learned, from identifying structure, understanding risk entries, to refining those entries using rejection and candle behavior, and applied it to real market situations. Remember, not every trade will be perfect, but your job is not to chase perfection. Your job is to build consistency, confidence, and control. So the next time you're about to take a trade, take a step back, look for structure, wait for rejection, and enter with purpose. If you got value from this, drop a like, leave a comment, and don't forget to subscribe so you don't miss the next breakdown. Until next time, trade smart, stay patient, and always stay sharp. Peace out.